Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor and finance presenter and columnist for the ABC.
I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder activist.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we, all three of us, are the Money Café for our final Money Café of the year. And not only are we all three here in the cafe, we've got, about a dozen people joining us from who are our listeners who have joined us
and
in
my
the cafe.
parents.
And your parents. James's parents are here too. That's fantastic. It's great. Well, g'day guys. Let's get stuck in now. We're going to talk about the winners and losers for 2025.
Yes.
Who's your winner?
My winner,
James?
I'll go first. It's two guys that most people haven't heard of, Oliver Curtis and Tim Rosenfield.
Straight out of jail.
They are the everyone deserves a second chance. They are the founders, the co-founders of a company called Firmus, which is an AI company. Of course it is. It has AI cooling technology. It wants to build AI factories. In October, this thing was valued at $1.9 billion. 6 weeks later, the valuation went up to $6 billion. Now, Sam Altman's good, Jensen Huang at NVIDIA's good, but I don't think anyone can beat that sort of gain in wealth in 6 weeks like that. This is an Australian company that is building data centres in Tasmania and Sydney and Melbourne with another company called CDC. I think
Phenomenal.
I have no idea whether this thing's going to work or not. I have no idea whether this will all end in tears, but that gain in wealth is incredible.
Data centres are going to work, aren't they?
Well, yeah. How many data centres we need? Do we need the ones in space that Elon Musk is hoping to build? I don't know, but it's an incredible.
Well, Sundar Pichai, the CEO of Google, talks about data centres in space.
Oh yeah,
every minute of the day.
I know. I'm
Anyway.
not sure I believe it, but anyway, well done to those guys. As Stephen alluded to, Oliver Curtis did spend time in the big house for insider trading, but this is a pretty incredible comeback, and good on him.
Who's your winner, Stephen?
Oh, look, I was wrestling with a few, but I've settled on Elon Musk because he's unflushable. Okay, he has survived everything. His share price is at a near record high today. He's got his pay deal up, the $1 trillion pay, although he's never going to be a $1 trillion pay. He survived Doge. He survived calling Trump out for being in the Epstein files.
Yes.
He's talking about a SpaceX float with a valuation of more than $1 trillion, and he's the richest man in the world, and Twitter hasn't bankrupted him. I mean, one of us made him loser of the year 2 or 3 years ago at this very event.
Yeah.
And he, as I said, he's unflushable. And he's just the richest man in the world. He's the most powerful man, and he survived everything. Much as I hate him, he's just incredible that he keeps going. And with all his talk about robotics and autonomous vehicles, it doesn't matter that he's losing market share with his electric vehicles. His share price is at a record high, and he's the richest bloke in the world.
Yeah.
And he hasn't been inside the big house yet.
He has not. Well, he's been inside the White House a little bit, but not the big house.
Yeah.
Who's your winner, Alan?
Well, I was going to go for Jensen Huang, who's the CEO of NVIDIA, but actually I've decided to go for somebody who probably nobody's heard of, is Sam Riegel, who is the CEO of and founder of Sunrise Energy Metals. Now, the thing is that what I was focusing on is the big deal that Albanese did with Trump about critical minerals and rare earths, right?
Yep.
And a lot of Australian stocks took off after that. That dig up rare earths and critical minerals, and Arafura rare earths, for example, was one of them, and Iluka and so on. But they've all come down again, except for Sunrise Energy Metals, which has got a scandium deposit in New South Wales.
Right.
Right in the middle of New South Wales, not very far from Forbes.
Okay.
And its share price has gone from 0.5 cent to 7.5 cents, which is absolutely heady stuff.
Yeah.
Right?
Yeah.
And it stayed there.
Yeah.
And the thing is that scandium is a very, needed thing, apparently. And not many people have got it.
There you go.
And Sam's got it.
He's not quite Jensen Huang, though, is he?
No. I'm not suggesting that. No. But it's a bit of a winner.
Yeah,
I mean, let's
bit
move on
left
to our
field.
losers, shall we?
I'll go first again. My loser is Jamie Ferris.
Oh,
and,
yes.
Corporate Travel Management. So this is an ASX-listed company. It's got a notional value on paper of $2.4 billion, but its shares haven't traded since August, when the auditor found some irregularities in its accounts that meant it couldn't sign off on the 2025 numbers. The board assured us that there was nothing to worry about. These were mere timing issues. And then at the end of October, we learnt actually Corporate Travel Management has overcharged British customers, including the British government, to the tune of about $160 million and needs to pay that back. Now, it's got enough cash to meet that, but whether this company survives in its current form is very doubtful. The shares have still not traded and probably won't trade until sometime in early 2026. And the great question is, what are they worth now? Are they worth 80% less than they were? Are they worth 90% less than they were? Does this thing go to zero? It's an incredible sort of story of suspended animation. And there's been a lot of shockers this year on the ASX. James Hardie, ASX itself, HealthScope, Monash IVF. I could name 10 of them, but I reckon Corporate Travel Management is particularly stinky.
I agree with that.
Yes.
Now, mine might be recency bias, but I'm going to go with Shane Elliott. Even Alan Joyce didn't sue for his banned bonuses.
Yes.
I mean, to come out and say, you're the smallest bank, you've underperformed, you've had all sorts of regulatory issues. The board have come in and cut bonuses by $32 million across the management team, including $13.5 million for the boss who they've ousted, because the board were going to get, REM strikes and huge protest votes if they didn't take action. The board had to be seen to take action, and
Yes.
Shane Elliott, tone deaf, already worth at least $30 million, is suing in the New South Wales Supreme Court for $13.5 million. I mean, it's just stinky of a Big Four bank who's very rich already to say, be a greedy banker and say more.
He couldn't care less, right? He doesn't care.
Well, I think actually he figures he's not going to get another gigs somewhere, and so he's going for broke here.
Yeah.
I think it's not just the bank he's taking on, because he's taking on APRA.
Correct.
And the government, because they've put these rules in place to claw back bonuses in these exact circumstances. The board has, in a way, followed the law. It's a very...
Do we think he's got a case?
Move. It's hard to see, yeah.
Yeah.
But look, he may have some agreement with the board that he feels was made in good faith, and he wants to test it.
But he's just damaging. I mean, the perception of bankers being greedy, gouging, self-interested. He's just giving the whole sector a bad name by doing this. Alan Joyce just sucked it up. He had a stronger case, Alan Joyce. He copped a $10 million hit, and he just said, God, imagine the PR backlash if I sue. He's going to do a book instead, Alan Joyce. Shane Elliott should forget about suing and should write a book. Write a book to get it off his chest.
Nobody's going to read that.
No.
Well, the AGM, the ANZ AGM is on tomorrow, Thursday. Any chance Shane turns up? That would be good.
Like the late, great Nobby Clark. Remember when Nobby Clark turned up at the NAB AGM complaining about Ahmed Fahour's salary?
Yeah, there you go.
Yes, no, I think he'll be off consulting with his barristers about his... this could cost him millions. Ben Roberts-Smith, it doesn't often work to sue Town Hall, to sue a bigger organisation. And ANZ's got a few more resources than him.
Yeah.
So, anyway.
What about you, Alan? Who's your loser?
I think Tim Ford, former CEO of Treasury Wine Estates. I mean, the thing about Treasury is how do you muck up a company that has Australia's only luxury brand?
Yeah.
Penfolds.
Yeah.
And the stock's down 60%. For the year.
Yeah.
I mean, as you say, there's plenty of big losers. Treasury Wine Estates is a big loser, and they've stuffed it up in the US and now in China as well.
Yeah, it's possibly all the things that aren't Penfolds that have really hurt.
Yeah,
Treasury.
of course. That's right. But the thing is, they've stuffed the company up.
Yeah.
by doing these other things.
Yeah.
If they'd just stuck with Penfolds,
Well, I
would have
think
been fine.
Ford's been trying to push in that direction, but it's just hard to get rid of these other
And they run their AGMs too early, 10 o'clock in the morning. The free wine is flowing at 11:10 a.m. That was too early as well. So for that, he deserves a
Sun's not even over the yard.
I know. So come on, Treasury Wine Estates.
Okay, all right. Now,
big stories to watch as well.
stories
Our
to
big
watch.
prediction of the biggest issue coming up, James.
Interest rates. So I think that we know the RBA is going to hike. Looks like Canada's going to hike. Europe will hike. Will the Federal Reserve in the US eventually be forced to raise interest rates? Donald Trump obviously wants them to be cut, but bond yields are telling us that rates are going to go higher. And if they do, every major share market bubble in history has been popped by rising interest rates, and it would be remarkable if history didn't repeat. So that is the thing to watch.
Well, yeah, but in that context, the question, the story to watch then is whether the Supreme Court allows Trump to sack Lisa Cook,
True.
the governor of the Federal Reserve, who he's trying to sack for some distant past apparent,
Trumped up charge.
Trumped up charge. And that's before the Supreme Court. If they agree and allow him to sack Lisa Cook, he could actually get control of the Federal Reserve.
Yeah,
and it's not absolutely a done deal in that case, but certainly closer.
Yep.
He won't get control of it by just appointing Kevin Hassett or Kevin Warsh as chairman to replace Jerome Powell, because Powell actually stays on for another 12 months.
He does
as a governor. So his number stays as a vote.
Yeah.
But anyway, I mean, certainly the case that if Trump managed to get control in some way of the Federal Reserve, they won't be hiking interest rates.
Yeah. No, I think all of the drama around the Fed's going to be fascinating to watch. But
this is just US interest rates. In terms of the Mr. Interest rates won't move for 2 years, Alan Kohler, what's going to happen with Australian interest rates? I mean, is it next move up or down, Alan?
Oh, it's not going to move for 2 years. I'm the broken watch that's stopped. You know.
The shallowest.
No, they're going up.
We're going to get on to predictions in a moment, right?
Yeah.
But yes, I mean, I'm going to be watching what happens with humanoid robots.
You love a humanoid robot.
I don't know. Sure, I love them or not. I just think it's an amazing story.
Yeah.
There's all these companies that are racing to develop humanoid robots. And what are they? What's going to happen to the world when these things suddenly start appearing everywhere?
Do you? So you've spent more time on this than any of us. Do you reckon it's like? Are we 3 years away?
Yeah, 3 or 5 or something like that.
Yeah.
I mean, there's
from seeing these walking around the streets here.
Well,
not walking around the streets, but being used in Australia.
Well, they're starting to ship them in China now, like just a few months ago, and selling them. So they're actually being sold now to companies, mainly to businesses in warehouses and all that stuff, mainly behind the scenes. But we're not far off having humanoid robots. I think it's a bit of a change for humanity.
Yeah.
All right. Well, my big story to watch is AI correction, ongoing crypto crash, and I think it all ties into Trump, and Trump into the midterms where his power will be clipped. So I think we've reached peak Trump, peak AI bubble, and
peak Trump.
Peak Trump. I think we've reached peak Trump. I mean, he's suing the BBC for $10 billion overnight. I mean, he should have been all of our loser of the year. We should be defending journalism from this corrupt scoundrel. But I think AI correction, it is a bubble, and I'm going to predict that it's going to come off. All those big Magnificent Seven are going to come off by close to 20% in the coming 12 months.
Boom. Well, I reckon it's already happening. If you look at it, Deutsche Bank's been tracking a basket of like 23 AI stocks. Since the end of October, 20 of them are lower. And if you look at companies like CoreWeave and Oracle, where the real speculation was happening, they're down 50% and 40% over that period. I reckon we might have seen the real froth has started to come off. A company like Iron that pivoted from being a Bitcoin miner to a data center company, they're off 60% in the last 8 weeks or so. So I think we're starting to see
the peripheral players.
The peripheral players, yeah.
But whether the Magnificent Seven, I mean, I think NVIDIA's in a league of its own because its CapEx challenge is not as much as the others.
Yep.
But I think I listened to one of your podcasts about the fact that NVIDIA's got 4 clients who are producing 60% of their revenue, and they're doing $88 billion a quarter.
Yeah.
So that means that the 4 of them are spending $15 billion a quarter on NVIDIA, just on NVIDIA.
Just on chips.
So the people spending that money, which is the Amazons and the Googles and the Facebooks and the Microsofts, I think that's the bubble. They can't sustain. They've destroyed all their positive cash flow. How can they go from the most cash-generative organisations ever to actually be borrowing lots of money?
But they got no
to
debt.
Fund this?
They got no debt. They can afford to borrow the money. But anyway, I think you're right. It is the other big story of 2026.
I spoke to a bloke yesterday who's trying to start Australia's first AI large language model.
Right. Okay.
Australia only, called Sovereign AI. He's calling it.
Right.
And he's raising $80 million to buy 256 NVIDIA Blackwell GPUs, which is going to cost him $80 million, and 256 Blackwell GPUs is what you need to train a large language model. And he's training it.
He might be a little bit too late, perhaps. Maybe hasn't got the global scale. Maybe
but he reckons that there's a place for an Australian one that has this Australian bias. I
remember hearing Atlassian boss Mike Cannon-Brookes give a speech probably 15 years ago, and his overwhelming message was, everyone in Australia who thinks they can just replicate what's happening in the US are deluding themselves, because we are 2% of their size. So don't invest in anyone who says, I'm just copying what's happening in America here.
Oh, Alan's poor mate will be heartbroken.
Alan's bloke sounds like just another one of those local Aussie copycats.
Jeez.
Sorry, that sounds a bit rough.
Look, good on him.
It'll be a great interview.
Good on him.
It is.
He's in this week's Talking Finance podcast.
There you go.
For the Intelligent Investor, if anyone wants to listen to that.
It is going to be a big debate here. Like there's the plans are to double the amount of data centers we've got in the next 12 months. It's not really clear where the power comes from for that. It's not really clear who profits from that, other than some big tech companies who don't pay any tax here. There's some really prickly issues around AI that for a country like Australia.
So, hey, listen, are we going to review our predictions for the year?
Yeah, we've got a question from Kurt, a very pointed question.
Oh, okay.
Kurt,
do you want to
help us with
that now? Do you want to do that question from Kurt?
Sure.
First?
Yeah.
I think you might need to invite a message from our sponsors, Alan.
Oh, you're absolutely right. So before we get to Kurt and the rest of our questions, let's have a quick word from our sponsor.
Investing doesn't have to be complicated. With InvestSMART, you get low-cost, professionally managed ETF portfolios, giving you smart diversification without the stress. And right now, InvestSMART is giving new investors a little boost. If you open and fund a new InvestSMART ETF portfolio before December 31, you'll receive a $100 bonus to help kickstart your 2026 goals. Whether you're aiming for long-term growth, retirement, or building wealth for the next generation, there's a portfolio to suit your goals. Head to investsmart.com.au to learn more. Terms and conditions apply.
Now, Kurt says, it's that time of the year again where I annoy the Money Café hosts with their past predictions. I remember they sounded a bit peeved at me last year, but that was all in good fun. Alan and Stephen predicted US and Australian stock markets would fall this year. US shares are up about 20% since that inaccurate prediction, and Aussie shares are up about 7.4%. So these bearish predictions were very wrong, which is fortunate for me and others who invest heavily. I can't quite be bothered to pinpoint a prediction from James, but safe to say there have been a few bearish ones throughout the year. I appreciate that he owns it, though, while sticking to his guns. Many thanks for the podcast and for reading this, if you do. Now, Kurt,
well, James,
we will cop it, Kurt. We'll read out your question.
And also, just to point out, James actually predicted the stock market would go up. Did you not?
No, I predicted it would go sideways.
Oh, I
yes,
see.
No, I have to own up to that.
I thought you predicted.
Alan and I predicted it would go sideways. Stephen said 5% up, actually.
Thank you.
So well done. You're actually right on the money at the moment for the ASX 200. I do note, Alan, that Kurt doesn't send in his own predictions, but we'll leave that. That's something for next year's correspondence.
Fair enough. But
do you want me to go through the other ones?
Well, yeah. I mean, yeah.
Do we have to?
Well, I'll own the prediction that interest rates would stay where they are.
Yes,
which I did predict.
I said,
and I was completely wrong.
Stephen said they'd end up at 4% at the end of the year. And I said the first cut would be in February, which I think it was.
It was exactly in February.
Yes.
So well done.
Thank you. House prices.
I would just like to say
yes,
that interest rates should have stayed where they are.
Oh, yes, you're probably right.
The Reserve Bank is now talking about, everyone's now talking about rates going up immediately. That tells you that the rates shouldn't have gone down.
And the housing prices wouldn't have surged up as much as they had.
Well, and inflation wouldn't have gone up.
They've caused a housing bubble by cutting interest rates too much.
So I'm, in my defence, Your Honour, saying that...
Yes, Governor Kohler.
that the 3 rate cuts were a mistake.
Ooh.
And I did say Alan should be on the RBA rate-setting board. And I stand by that prediction.
Yes. House prices. Alan said down by a few percent.
Yeah.
A few.
Wrong, incorrect.
Not very specific.
Stephen stayed out, and James said up by 5%. Which
well done, James.
I think is about right.
Exactly right.
So what about prospective though? Where are house prices going now?
House prices are going to be up next year. Westpac has a prediction they'll be up 9%. I can't see that. I reckon it's more like 7%. Alan?
Oh, 5. But I mean, look, it depends if rates go up. If they hike rates in the first half of the year, then they'll go down.
Oof. Ooh, that's a conditional prediction. I'm going to say they'll go down 5% next year because rates will go up.
Okay.
No ifs or no buts. That's what's going to happen.
And interest rates, where are they going, Steve?
Confidently wrong, as usual. Interest rates, as I said, they'll be going up. Inflation's genie's out of the bottle, and up they go.
Yeah. Well, I had a graph on the news last night with the heading of which said the Australian economy is going flat out, and I said that the Australian economy is now a jalopy.
Jalopy
that is in the slow lane because the engine will overheat if it goes any faster than 30 k's.
Right.
So we can't handle growth.
So
we just have an inflation breakout with growth.
After all that, what is your rate prediction?
Well, I think there'll probably be 1 rate hike.
I'm going to say rates are on hold for the entire year.
There you go. You're going to take over my prediction.
I reckon there'll be a bit of jawboning. The RBA doesn't want to hike if it can avoid it. Yeah, RBA on hold all year.
It's very unusual, isn't it, to have some people not knowing if they're going up or down. Well, I mean, do you remember the last time?
No, I don't think it's that unusual.
No, I think it's okay.
People never know.
We were predicting rate cuts a few weeks ago, though.
Totally.
Going down,
that's
down.
the unusual bit.
Yeah, that's right. That's been a total in 3 months, 2 or 3 months. It's been a complete, 180 degrees about face.
ASX 200, Stephen?
Up another 5%.
Alan?
I don't know. I mean, it's mainly about banks and miners in Australia. Banks are expensive. How can they keep going up? I don't know. Miners depends entirely what happens in China and the global economy. So look, China's economy is subsiding. They're doing well in AI and everything, but actually the economy, the domestic economy of China is going down, and especially the property sector. So maybe the steel demand, the steel production the iron ore demand is not going anywhere. I mean, it's possible that both the miners and the banks do nothing next year, and we haven't got enough technology stocks. And anyway, as you say, maybe the technology boom's over as well. So look, okay, sideways. ASX sideways.
I'm going to say the same. The ASX 200 is flat, but it's up 10% in the first half of the year and then gets back to flat by the end of the year. Ooh. I think the first half of the year is going to be very, very... the global economy is going to run hot in the first half of the year. I think miners will pull the market up in the first half of the year. Okay,
well, we'll be in the first half of the year, June, in a Money Café in June. We'll have a...
Kurt will be back at me.
Yeah, That's right. Kurt's going to have another field day in 12 months' time.
I know.
All right, so other questions. Claire loves the podcast. Questions on the claims of Coles that they have less than a 2.5% profit margin, with Woolies claiming similar. Both companies have huge portfolios of real estate, liquor stores, home brand lines, etc. I find it hard to believe they can only return a 2.5% return on average across their business. Is this selective reporting? Or put it in grocery terms, are the grocery accounts a loss leader while they make bank on the remainder of their business? Now, I guess, James, you should probably start with this because you've been the chief defender and apologist of supermarket profit margins. They're reasonable.
James is all over the subject.
This is a fascinating question to me. We're 12 months, we're 12 or more months into the debate about are the supermarkets price gouging, and we're still getting this idea. Claire is suggesting that the supermarkets are hiding profits and manipulating their accounts. Like they've got hollow logs somewhere that they're squirreling the profits away. It's just not happening, Claire. Don't worry. There's no money. The liquor stores make less than the supermarkets. They don't own any real estate. It's all leased. The home brand lines, that profit goes through the grocery stores as well. Coles is doing fine, but the profit margins are at a net profit line are not very large. It is a high volume, low margin business.
Haven't we got another inquiry into the Albanese has announced?
No, we've got some new laws coming in that specifically target Coles and Woolies, basically, and if they've found guilty of price gouging, which the ACCC spent 12 months investigating and found no evidence of.
And I'm going to defend them as well. The combined value of Coles and Woolies at the moment is $65 billion, and that is only 1/4 of the Commonwealth Bank, which is worth $260 billion.
Yeah.
So if you really want to talk about people gouging, look at the big banks. There's 4 of them. There's only 2 big grocery duopoly players, and they're not making out like bandits. They're getting flogged by the regulators. They've got...
I don't agree that the banks are making out like bandits either. Banking has become a low-margin, fairly crappy business too. Yeah. You want to get into AI.
And Stephen, they just happen to be big because of the housing market in Australia, which is now worth 11 trillion.
12 trillion.
12 trillion.
We have... Australia has... 1 or 2 players or 3 or 4 players in most industries. They do look really big. Doesn't mean that they're good businesses.
Yeah, but if retailers ripping people off, have a look at Bunnings and their profit margins. Wesfarmers is worth $92 billion. Have a look at Chemist Warehouse and their category killer. They're worth $33 billion, Sigma. They're worth more than Coles. So I would argue the retail rip-offs are happening not with the supermarkets. It's happening in the likes of Bunnings and Chemist Warehouse, where they are making super profits.
Yeah, I'm not sure I agree.
Okay, so here's a plaintive question from Sam, who says, my partner and I are 30 years old, working professionals with a good combined gross income of around $250,000, live in Perth. I feel like our ability to buy a home is quickly eroding before us. We began looking in the middle of 2025, and we've seen properties in what we would call less desirable suburbs increase from $750,000 to $1.1 million and even further. We would love to own a home, but now feel like it's getting away from us. So what are your thoughts on both of these issues? No financial advice at all, of course. So what's he actually asking?
Well, he's asking whether he's setting up an investment account with a margin loan.
Oh, yeah, that's right. So he's got a margin loan to try to make up ground.
Correct.
In shares. What do we think of that? What do you think, Stephen?
Well, I at $250K, I think it's amazing that $250K is not enough to buy a reasonable house in Perth. That's the story.
Of course, that is the story.
I think we need to change the way we report. Public companies, we report net profit. With people's income, we should report after-tax income because our tax rates are so high, our income tax rates are so high, that a couple on 250 are actually on less than 150 because the government's taken about 100 of that. And you can't tax deduct on your mortgages, that's the stuff. So you need to be on a massive salary to buy a house in Australia. It's a tragic story.
Yes, that's right.
And young working people are being hit too hard with massively high tax rates, and the housing market is unaffordable. So it's a really tough story for poor old Sam.
And they feel they have to take some pretty big, reasonable sized risks, taking out a margin loan in order just to close the gap to put a roof over their head.
And so, Sam, on the question of whether we like the margin loan idea, the problem with that is that you get caught when the market goes down a lot.
Yeah.
And the margin loan lender asks for a top up. You have to top up if the value of your assets goes down, and that's the problem. And the trouble is that stocks are high at the moment, and people are kind of talking about a crash. Now, maybe there won't be a crash, but if there is, and stocks fall 30%, then you're going to have, you're going to be in trouble.
But Sam's smart. He's waiting for that 30% correction before he's going to activate the margin loan. So he's got it set up, waiting for the crash, and that actually is the way to play the margin lending.
That's right.
Thing.
Yeah. You just got to you've got to know your own risk appetite, I think. Yeah,
sure.
Sam. 2 questions from around AI here. One is on the idea of a universal basic income. Craig's asking, what are your thoughts on the government removing the age limit to accessing super at preservation age and instead being able to access a drawdown, say 4% at any age once you hit the $2 million cap? So you'd be basically funding your own universal basic income if AI kills all the jobs. And then Keith says, I continually hear from you learned gents that the key to unlocking the potential of the Australian economy is productivity, and those productivity gains come from AI. But if the only people to profit from these gains are a few tech bros and super funds, is the sacrifice to the rest of us actually worth it? That is a very good question.
It is.
I reckon we need a universal basic humanoid robot.
Yeah.
And a universal basic AI personal assistant, where the government, like with Medicare, where the government steps in and bulk buys, like they do with pharmaceuticals, and delivers everyone robots and AI assistants to help them get through, not having a job because your job's been smashed by AI.
Yeah. Do you think your robot would comfort you when you lose your job? They would pat your head or something like that?
I mean, I think everyone should have a robot. The way it's going, Alan says it's the biggest thing that's going to happen coming up, and so but look.
Well, look, whether we get humanoid robots or what, we've got AI. We definitely have AI, right? And it's happening. And the question is, what's the level of unemployment going to be? Nobody really knows. So there's a lot of debate. Everyone says, oh, well, you look at previous technology booms, and other jobs came along. So it won't be. We won't all lose our jobs. Other people say we will all lose our jobs, and nobody actually knows what's going to happen, right? But I think it's fair to say probably that unemployment won't be 4%.
No.
But who knows whether it's 10 or 50? I don't know. But the thing is, if it's 50% unemployment, either because of AI that we've already got or humanoid robots that are coming, then they are going to have to do something about keeping people alive.
Yeah, totally.
So something has to happen, whatever you call it, UBI or whatever, they're going to have to restructure the way welfare and taxation works, because taxation's based on personal income, labour income, and if half the population isn't earning that anymore, then they're going to have to tax something else, and then they're going to have to redistribute the money properly to people who aren't earning a wage.
So they'll have to tax capital more than labour going forward.
And I reckon that'll have to happen if permanent unemployment exceeds 10%. So we're all living with permanent unemployment effectively of 4%, right? Because that's what the central banks are saying is full employment, 4% unemployed.
Yeah.
Right. Well, if unemployment goes to 15% permanently, well, there's something will have to be, because that's going to be too much of the current job seeker won't work.
No.
Right?
No.
So they're going to have to rethink about how those people are supported.
You'd have to rethink almost everything in society.
Precisely. That's right. I mean, if
But my question is, who's thinking about that at the moment? Is
nobody.
anyone even considering that?
People are thinking about it, but nobody in power is actually preparing for it.
Yeah.
I mean, if all these companies, I think there's about 20, possibly more companies, and plus China, building humanoid robots, right? And they all reckon that they're going to sell tons of them. So if they're right, they're all going to do something. Those humanoid robots are going to do something that a human being currently does.
Yeah.
Right?
That is the thing. If AI works, lots of people lose their jobs. That's the central equation here.
Precisely.
Yeah.
I don't know. It hasn't happened yet. Like, people are saying it's a jobless boom at the moment, but there's not mass sackings. People are not hiring, and it's harder for the young university graduates. It's actually very tough at the moment.
Yeah, it is hard. Yeah, but it took
It'll take.
It took 40 years
only,
for America to be electrified, for example. Now,
it's
this
only
is
just
moving
begun.
quicker than that. We're in the
just
early
started.
stages. Yeah.
What's the other question about?
Taking money out of super. Once you hit 2 million, should you be able to draw down?
Oh yeah, but you hit 2 million when you're 80 years old.
Yeah.
Come on.
Yeah.
if you're lucky.
Although, I guess younger people might. But I think, all I'd say about that question, I think it's from Craig, is they're the sort of things, everything will be up for grabs if employment really spikes. So maybe, maybe all that goes on the table.
Unemployment hits 10%. The governments will be unlocking super to help people survive. There'll be massive political pressure to do that.
Well, sure, but that's right. But the people who are losing their jobs won't be the people with $2 million in super.
Yeah.
There'll be people with 300,000 or 400,000 in super, and that won't be supporting them.
Yeah. Now, Stuart says, love the podcast. APRA's announced that a high-risk loan that has debt-to-income ratio above 6 times and that loans above this 6 times threshold can only make up to 20% of new bank loans. So if you're a double-income family earning a combined $200K, can you be loaned $1.2 million without breaking the threshold? But if you then consider the 5% deposit scheme, then nearly all of these loans will be borrowing 95% of the loan and will be considered a high-risk loan by the APRA standards. Am I getting that correct, or have I missed something? So, these contradictory messages by regulators and governments that APRA is coming in saying, banks, we're going to limit you, you can't do more than 20% leverage ratio, yet the government's going,
or even
you can borrow 95%. That's fine. It's contradictory.
Sure.
Yeah, I mean, yes, it's up to I don't think there's going to be a real impact from this on lending, but yes, there is a contradictory element here. Everyone's just having to take on so much debt to buy a house.
That's right.
It's it goes back to our earlier question about the couple on 250K. So Stuart's right. There is.
And the thing is,
almost every loan, in a way, could be considered a high-risk loan.
And the thing is that there's no prospect of house prices coming down to the point where you don't have to take on that much debt.
Yeah.
We may get to a point, if they continue, if the policies all work, that house prices don't rise as fast as they have been in the past.
Yeah. And to your point about AI, there's no prospect that wages are suddenly going to explode up to change the debt-to-income equation.
Precisely.
But who would you rather be? So we've got $12 trillion in residential property. As a nation, we've got more eggs in the residential investment property market than any other country in the world. Whereas in the US, they're saying that 52% of wealth is in the stock market. And they've never had as big a proportion. So would you rather be America, massively overweight the booming stock market bubble, where it's 70% of world stock market values? Or would you rather be Australia, a housing bubble, $12 trillion in housing and far less exposed to equities?
No, I think Australia is exposed to equities. We've all got lots of money in our super.
Sure.
I don't think we're necessarily...
But not as exposed as the Americans. We're all exposed to the American share market because we've got $120 billion invested through super funds in AI. Yeah. But it's diversified at least.
Yeah.
Henry says, I've been thinking recently about how important a strong opposition is in our government system. This is called Money Café, Henry, not Politics Cafe. But anyway... we have for a long time suffered from poor opposition, both in political strength and an unwillingness to back good policy and seek bipartisanship. I think we need to increase the respect that comes from being in the opposition, increasing the standards of expected opposition members and portfolio heads. Yeah, fair enough. But
I was thinking about this, Alan, in the context of one of our highlights on the Money Café this year, our interview with Jim Chalmers.
Yes.
Before the election.
25,000 downloads, that one.
Even the very hint of strong opposition made Chalmers come and spend an hour with us, which was absolutely fascinating. I've never heard him talk like that before or since in a public way.
With no notes.
No notes. But now, what are we getting? We're seeing, he knows what the opposition are. He knows the opposition's stuffed. All the momentum of that he... All the big ideas that were in that podcast, they've sort of been parked. Henry's exactly right. Strong opposition's so important. You can just feel the government has been happy to drift along as they've seen the
Well, and the opposition, the Liberal Party, Liberal National Party, is imploding. I mean, it's just terrible.
Totally.
But Henry's saying that the shadow treasurer should be paid the same as the treasurer. So he's saying pay them all the same, and somehow this will make them more collaborative and we'll get more bipartisanship. I'm not sure that it would. And frankly, if you paid the shadow treasurer the same, you'd have less incentive to get into government and be a good opposition, because you can sit back and bludge away as the shadow and in the same money as the bloke who's got the real tough job.
All you've got to do is wake up every morning and think about what you're going to say rather than what you're going to do.
Yeah, that's right. So absolutely, government's ministers should be paid more than their shadows.
Of course. Well, they do a bit more work.
They certainly do. So now Ben says, I submitted a question a few weeks ago about taxing billionaires more effectively to address inequality, but it wasn't answered. Perhaps too politically sensitive. Now I'm reading John Kehoe's Financial Review article, High Income Tax Causes Property Investors to Negatively Gear, which argues that Australia's high marginal tax rates, 45% top rate, creates strong incentives for negative gearing. And he suggests lowering these tax rates or adopting a Nordic-style dual income tax system where investment income is taxed separately at a flat rate and investment losses can't offset wage income. And this could reduce property speculation and help housing affordability. Now, John Kehoe is your colleague, James. I agree with his argument that our income tax rates are too high and it's distorting and giving everyone a massive incentive to borrow up and negatively gear into property.
I think the problem with the top marginal rate, it kicks in too early, 180,000 or something.
Yeah.
So it's just too, you start paying it when you're not making enough money.
Yeah. Yes, I mean, I think these are all... I think there is something to what Keogh's writing about, and this is the problem. This is all wrapped up in this: how much do we tax capital versus labour, and how sustainable is it?
Yeah.
And I think that the less sustainable it gets, the more people try and find ways around it.
I certainly think we're going to be taxing capital more in future than we are now. Because labour is getting replaced.
And Ben's saying, how do you tax billionaires more effectively? Well, I mean, the most obvious one would be death duties, inheritance tax, 10%.
Yeah.
Billionaire dies, 100 million for the government.
Which there's plenty of economists who say we've really missed a trick getting rid of death duties. You guys would know more about this. There was a lot of political pressure in the 70s and 80s, but most countries have some form of death duties.
Yeah.
And eventually we'll probably have to go back there.
I think so.
Yeah.
Well, we introduced them in 1915 and got rid of them in the 70s.
Yeah.
Big mistake.
Which was a mistake.
Yep.
For sure.
John says, Dear Stephen, I agree with you regarding Jeff Wilson and Wilson Asset Management, his 100% owned funds management company. There is a conflict of interest with being chairman of all the LICs as well as reaping a 1% plus management fee from all 9 funds each year. I've invested in probably 6 of the 9, over 400k in total, and although the funds have generally done well, usually in excess of the benchmarks post fees, I feel we need an independent chairperson for each LIC. Against this is the cost of such. Jeff is probably saving the funds money by running all the AGMs on the same day and location. Is there a way we could introduce an AGM resolution to cause a review of management fees triggered, for instance, by 2 straight years of below benchmark performance? I think that would please most fund holders.
Well, I mean, I do remember post-GFC, Macquarie was under a lot of pressure, and at the end of the day, all of their externally managed funds, Macquarie Airports, Macquarie Infrastructure Group, they got pressured into unwinding all of them because there was just hundreds of millions of fees were leaking. So Jeff Wilson's now taking about 70 million a year in fees from the $6.4 billion in under management. And the only way to change that is for the board of these LICs to negotiate a better management agreement or internalise it. And as long as Jeff Wilson is the chair of all 9 boards and is handpicking who comes on and joins him as independent directors, that'll never happen. So the way to reform this is to get Jeff to agree there's a conflict of interest. You can't be on the board negotiating contracts with yourself and then have independent directors say, Jeff, you're going to be a billionaire in 3 or 4 years if you keep this up. Can we renegotiate? Because if we cut the fees to 50 basis points, not 110, the share prices and all the LICs will go up by 5% straight away. But he's on a good earner. Everyone loves him for their franking credits, and he's getting away with it.
But there's no one's going to make that happen, are they?
Well, I'm going to run a campaign next year, but it probably won't be very effective. But
no, it won't be, I'm afraid, Stephen.
Anyway, what do I know?
Okay, so I don't know, how do I say that? SIAC?
Sajak, I would have said.
Sajak.
Yep.
S-J-A-K. Sjak. Let's say that.
Jack.
Yeah. There are dangers in the knock-on effects of building all these data centres. At first, they came for the hobbyists via their GPUs, and nobody batted an eye. Then they came for the PC and console buyers via their RAM, and the memory suppliers said they would increase production. So up went those prices too. Next in line will be all consumer electronics relying on silicon. Wouldn't that be inflationary too? And with profit margins squeezed, we'll be looking at a major hit for the customer-focused tech retail economy. More importantly, if Australia tries to chase after data centre money, will that risk hiking our electricity prices as it has in the USA? Or will they be pressed to build their own solar, nuclear and not to mention the real water usage? ChatGPT may be cheap for us to use more, but the real costs appear to be socialised. I think that's a really important question because the data centres, including those in Australia, are soaking up a colossal amount of energy, which is why they're talking about putting them in space.
Yeah.
So that they collect the sun, directly rather than having it go through the atmosphere.
Yeah, there is an inflationary problem. I don't think it's through the cost of silicon or RAM. It's through the cost of electricity.
Exactly.
We're seeing in areas like Richmond, Virginia, where the US data center sector is based, household electricity prices up 267%. If that happens here, people are going to be saying, sorry, why am I paying this again? So we can get faster cat videos off the internet or, AI can impersonate Alan? I agree. This is going to be a real issue.
I had lunch last week.
This is why the government is a little bit hesitant about, the AI, the national AI blueprint was total crap. It was so poor. It was such a poor document. It was embarrassing.
It was a brochure. It was terrible.
It was a poorly written brochure.
It was terrible.
And that's why, because the government's not sure it wants the knock-on effect of higher electricity prices to be sheeted back to it. Because that'll be the thing. Sorry, you told us AI is really good, and now my power bill's up 300%?
I think it's more because the unions control the Labor Party and they're worried about the job loss factor. And energy is secondary to the hopeless AI strategy document that they put out.
On this subject, I need to tell you about lunch I had last week with a guy who's got a startup in Australia called Space Solar Technologies. Right, That's the company's name. He's trying to get this going, and he wants to start a solar panels in space thing. And he reckons it'll be really cheap power. And the way it works is, and this is true technology, they have these satellites with 2.5 kilometres worth of wide of solar panels, and because the things are above the atmosphere and they get 24 hours a day sun.
Yes.
There's no night. Right?
Yes.
So it's all sun all the time, and it's unfiltered through the atmosphere. It's really powerful. They convert the electricity that's created into microwaves. The microwaves get beamed to Earth and converted back into electricity on Earth. That's the idea. And he reckons it's really cheap. But he can't get anyone to get interested in Australia. Anyway.
But if Google's talking about it,
these guys.
Oh yeah, they're going to have a crack at it. Definitely.
Apparently it's cheap and it's going to work. And so they're talking about having the skies full of these solar panels beaming electricity back to Earth, and that's how it's all going to.
Well, if you think about winner of the year, Elon Musk is generating $10 billion a year in revenue from Starlink. So he has blazed the trail. He is proving he can do business out of space, and so why not data centers and electricity generation if you can do internet?
But as I told you about that, I felt like this bloke who's trying to get everyone to listen in Australia, because you guys, your eyes just glazed over as I was talking. I could see I lost you at the word microwave.
Yeah, you did. Sorry. I'm going to skip ahead a few. We're running out of time a little bit. Douglas from Hobart says, love your show. What will the impact of the baby boomers moving to aged care or passing away be on house prices? Surely we will have a demographic surge coming soon from this generation. Is this the event that will release a tsunami of supply onto the market? Would love to see an Alan Kohler 2-minute ABC piece on this post.
Yes.
What do you reckon up, boss?
Oh. So, hang on. The proposition is that as the baby boomers die
and move into aged care,
or move into aged
increase
care,
housing supply, reduce prices.
Okay. Yeah, maybe. I suppose.
I think immigration levels will be a much bigger factor than that. And the government should do more incentives to get people to downsize. I mean, the downsizer incentive, stamp duty, holidays, that's such an obvious way to free up housing supply.
Yeah, sure, that's right.
And they're not doing it. They're not offering anything.
And there's a disincentive to downsize, which is the stamp duty.
Yeah. Good point.
Now, Josh says, do you think part of Australia's stubborn inflation comes from an intertemporal preference shift?
Ooh.
Now, that I looked it up. This is a chat GPT question from Josh. An intertemporal preference shift is the incentive to do something for a short-term fix rather than acting in your long-term interest.
Oh, right. Intertemporal.
So he then goes on to say, especially for younger Australians who feel they'll never be able to afford assets like housing, so instead they're spending their money now in this future doesn't matter mindset. So what do we think? Is this driving inflation because young people are just spending it while they can? I guess it's an interesting point because the biggest incentive to save is the moment you've got your first mortgage and you suddenly realise, oh my God, I've got to pay this every week.
Yeah.
Plus when you have kids, of course, and you realise how expensive that is. But I don't know. Are young people really spending all their money because they can't afford to buy a house?
I think that the question is partly to do with how much cheaper is rent than mortgage repayments, because rent's pretty high. You know, I mean, I think it is. I think rent is a bit cheaper, so you have got a bit more money to spend, but not that much more. You're certainly not. You're certainly not flying business class to Europe.
I was trying to think of another intertemporal preference shift, and I was thinking maybe
of course you were.
The ASX. The ASX has been refusing to invest in their long-term infrastructure and take a long-term view.
Yes.
And instead they've just been paying out 90% of profits in dividends.
That's the intertemporal preference of most companies, isn't it?
Well, that's right. And the great Australian story with franking credits is just pay out the cash and don't invest in business unless it's data centres.
Yeah.
No, we've probably got to finish up with Hans. Hans has got the question of the day. Dear team, with a special mention to Greg, this is collectively on behalf of all Money Café listeners, we apologise to Greg for mistaking his very real voice for AI. Thanks again for all your work. Now, this is the thing about Greg. He's got the best voice of everyone on this podcast.
He certainly does.
Yeah, we only get to hear the message from the sponsor.
Yeah.
And Greg is real. He is a legend. He's the best journalistic all-rounder I know.
Yes,
all
indeed.
Things tech, subbing, producing, sourcing all your interview talent. Alan?
He does, exactly.
What a machine.
We can't thank you enough, Greg, for all the work you do to make us look good.
And he's come up with these trophies, which is, for those who can't see it, they are microphones made of what seems to be bronze.
Bronze,
yes. Oh, pure bronze
microphones on top of a little stand that says Alan Kohler, the Money Café best host.
Yeah.
And, well...
We're the equal best co-hosts.
Yeah, well, it's tough fields for all of those awards too. Oh, that's right. A lot of challenges.
I do hope Greg has put this on expenses.
Yeah. Me too. Me too.
Because Greg is
but knowing him, he probably hasn't.
Because you realise this is the 6th time we've had a three-hander in person.
Wow.
So we've had 4 year-enders. We've had the Jim Chalmers grilling for an hour, and we celebrated our 1 million downloads. We had a catch-up when we had 1 million downloads. And Greg tells me we're now at 3.44 million downloads over the life of the Money Café.
Isn't that great?
And Greg puts it together for us every week.
Yeah, well done,
go.
Greg. Can't thank you enough, mate.
We'll be challenging the rest is history before long.
Yes.
Well, we are growing. 20% a year. We're doing well.
20%.
There you
Goodness
go.
me. Well, thanks everyone for listening to the Money Café today and all year. We've really enjoyed bringing it to you. And we'll be taking a break over the summer. We'll return on Wednesday, the 28th of January, 2026. So if you've got a question for then, please email it to themoneycafe@eurekareport.com.au. We're all looking forward to 2026. I must say, it's going to be a really interesting year.
Totally.
I mean,
full of inaccurate predictions.
It's going to be great. I mean, think of what 2025 brought us. It could be even crazier next year.
Well, I've just been reading a book that was published in September about super intelligent AI.
Right.
The title of the book is "If Anyone Builds It, Everyone Dies," and I've just been. I mean, I fair dinkum, you wouldn't be dead for quids with what's going on. It's so interesting.
Well, you've got to look after your robot soon, so.
Well, yeah.
And Alan, we should thank the fantastic audience that's come down to see us today.
Oh, amazing.
Can we get them to give like a clap or something so
Yeah,
people know they're
all
real?
give us a shout. Hey.
Thanks for coming, everyone.
Well done.
Well done. Thank you. We've taken over the cafe.
We have taken over the cafe.
Yeah.
Stay safe, everyone. Have a great Christmas and New Year, and we'll see you in 2026. Until then, I'm Alan Kohler, founder of Eureka Report and finance presenter and columnist for the ABC.
I'm Stephen Mayne.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
See you next year.
Bye-bye.